We're going to create a dividend portfolio today using $1,000. We prefer dividends because they truly qualify as passive income. Simply purchase the stocks, go to sleep, and wake up at predetermined times during the year, and presto, you reap the benefits. So let's expand on it today. Welcome to Stock Market Mate. Here on YouTube, we produce videos on the latest news, ideas, and research on investing within the stock market. You guys frequently ask us how to truly begin your own dividend portfolio, so now we'll take you step by step through it. You will learn the following by watching this video. Number 1. The benefits and drawbacks of beginning a dividend portfolio. Number 2. Key considerations when choosing stocks for a dividend portfolio. And number 3. An example dividend portfolio that we created with $1,000. Additionally, we're going to analyze a handful of the stocks we picked for that $1,000 portfolio for you. To help us fight the YouTube algorithm, please subscribe to the channel and click the notification bell before we begin. Let's move on if you're finished with it. Pros and cons of a dividend portfolio. We'll start by discussing the advantages and disadvantages of a dividend portfolio. Beginning with the pros, passive income is first on the list. Owning a dividend portfolio is a legitimate source of passive income. Actually, all you need to do is purchase the underlying security and you'll occasionally receive a dividend payment. If you don't know what a dividend is, it basically means that when you purchase a stock, the firm will distribute a portion of its profits to its shareholders because it has made so much money. Dividend stocks typically belong to bigger blue-chip corporations. It is entirely conceivable to amass such a sizable portfolio of investments that you can suddenly live off of your dividends. But to do that, you do need to invest a lot of money. Compounding returns are the second benefit of owning a dividend portfolio. Reinvesting dividends causes growth to compound and essentially launches your portfolio into the next stratosphere. And finally, dividend portfolios offer protection from inflation. Since 1912, dividend growth has averaged 4.2% per year. Additionally, inflation during the same time frame was about 3%. In a dividend portfolio, there are various drawbacks that we'll quickly go over. The first is that you exclusively invest in and own large-cap businesses. And the reason is that most dividend-paying stocks are blue-chip corporations, which are already well-established and can pay you a dividend. So you really don't get that with dividend-paying equities in terms of diversifying your assets across all different types of firms, such as smaller companies that have tremendous development potential. Second, your earnings could be limited. The share price often decreases by the amount of the dividend paid when a corporation pays a dividend after the stock goes ex-dividend to reflect the fact that the new shareholders are not entitled to that payment. Also, businesses have the right to stop paying dividends at any time. A firm does not technically owe you a dividend solely for having its stock. They are not guaranteed. Now obviously, some of the so-called dividend aristocrats have been consistently paying dividends over the previous 25 years, and have also had dividend growth over that time. Therefore, they are unlikely to reduce their dividend. A huge firm like Disney, for instance, just reduced its dividend, which is one of the drawbacks. Dividend-paying equities may or may not continue to pay a dividend in the future. The benefits and drawbacks of holding a dividend investing portfolio are listed above. Building your portfolio. Key components. A dividend portfolio is actually a smart idea for you if you're a long-term investor looking for some income flow, according to our opinion. A dividend-paying portfolio can be a little bit too safe or a little bit too dull for you if you desire high growth and want to diversify among many different companies, including small mid-caps, small caps, and other form of investments. Dividend-paying stocks will either continue to pay dividends or not. The benefits and drawbacks of holding a dividend investing portfolio are listed above. Component number 1. Track record. But suppose we wish to put money into a portfolio that pays dividends. What are the essential elements that we need to check for? The first thing we want to look for when beginning our own dividend portfolio is a firm with a proven track record of paying dividends. When investing in a dividend-paying stock, the last thing you would want is for it to lower its dividend because it would be bad. You may search up a company's ticker symbol on Yahoo Finance, Google Finance, or Dividend.com to see how much it actually pays in dividends, or you can just look up its dividend history. Component number 2. Yields. Examining the yields but not chasing the dividend yield is the second element of a dividend investing strategy. As a result, different corporations will pay dividends in amounts that vary depending on their share prices. That's what's referred to as a dividend yield. A firm like AT&T, for instance, pays a dividend of $2.08 every year, or 7.33% of its share price. Compare that to Home Depot, which pays a dividend of $6 each year, or over triple the amount. However, it only represents 2.23% of their share price. Therefore, if you invested $1,000 in AT&T, you would receive 7.73 of that amount back each year. and if you put $1,000 into Home Depot, you get 2.23% of that back each year. The most important thing to remember is that high yields are not always advantageous. Many dividend investors become enamored with extremely high yields like those, especially when it comes to the business that gives them the biggest proportion of their money back. But these businesses don't usually do well overall. A corporation is probably not reinvesting its profits and working to grow and expand its core business if it's giving out big yields on its dividends. Component number 3, dividend payout ratio. This takes us to our third and final point, which is that you need to be aware of the dividend payout ratio. Simply dividing the total dividends paid by the company's net income yields the dividend payout ratio. The simplest approach to explain this is to use the example of a corporation that makes $10 million in profit annually and distributes $5 million in dividends. 5 million divided by 10 million equals that. Their payout ratio is therefore around $50. Every year, they distribute half of their profit as dividends. Because all of the company's money goes back to its shareholders rather than into the business, the more dividends it pays to its shareholders, the less it actually invests in its business. Component number 4. Diversification. Finally, diversification is the fourth quality we should look for in a dividend portfolio. Our ideal selection would be between 15, 20, 25, or 30 dividend-paying equities from various industries. With a dividend investing portfolio, we are making investments to meet our future cash flow demands. Regarding overall growth, we're not aiming for the stars. Yes, it's a bit tedious, but boy will it make you sleep better at night to know that your investment portfolio won't be overly volatile, especially if it's diversified throughout a wide range of businesses and industries. Dividend stock highlights. Home Depot. So in a nutshell, we wanted to highlight some of the stocks we selected for our dividend investing portfolio and outline the precise reasoning behind those selections. Home Depot comes first. Using the Yahoo Finance website, we can see that Home Depot is currently trading at $278 as of the time of this video. The low is $140 and the 52-week high is $292. They yield 2.2% and distribute a $6 dividend for each share. According to their data, they have a profit margin of 9.91% and a dividend payout ratio of 52.33%, which indicates that they currently pay out about half of their profits as dividends. Home Depot is not an aristocrat of dividends. Home Depot maintains its financial stability though, indicating that the corporation will likely at least maintain or increase its dividend in the years to come. Coca-Cola. We also want to talk about Coca-Cola shares. As of the time of this recording, Coca-Cola is trading for about $49. Their low is $36.27 and their 52-week high is $49.56. Its stock isn't particularly volatile. It has a payout ratio of 76.42%, a 3.33% annual yield, and a $1.64 dividend payment per share. The profit margin is a great, robust 26.77%. One of the longest running payouts ever was offered by Coke. In fact, it has a higher status than Dividend Aristocrat, which is referred to as a Dividend King, because it has been paying and raising dividends for the past 58 years. Visa. Let's discuss Visas lastly. The price of Visa as of this recording is $201. The low is $133 and their 52-week high is $217. The current dividend payment is $1.20, which is not a particularly big amount, and their dividend payout ratio is a respectable 21.86%. However, with a 51.37% profit margin, they do have a very high profit margin, and we would purchase these shares in order to benefit from a small dividend as well as the potential growth of the underlying firm stock. Growth and debit transactions are really increasing as of the second quarter of 2020, largely because of the COVID-19. Additionally, there has been an increase in payment volume. Visa is not going anywhere, to reiterate. In fact, we anticipate that in the future, people will use credit cards far more frequently than they will cash. Well, there you have it then. With that dividend portfolio, you could start investing with just $1,000. Please hit the like and subscribe buttons if you found this video useful. You might also want to comment below. We appreciate your time and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!